get started. First and foremost, thank you all for joining us for our first National Virtual Speaker Series event. We wanted to give you all an opportunity to learn and develop as leaders while most of us are transitioning into a fully digital world. As Steve just mentioned, the call will be recorded, so if you object to that, you may disconnect at any time. Our first speaker who is speaking tonight is Ralph Acampora. Ralph is a 50-year veteran of Wall Street and one of the most renowned analysts over the last several decades, known for pioneering technical analysis. Ralph is known for creating the Chartered Market Technician Association, predicting the rise of the Dow, and for being a frequent panelist on Louis Rukeyser's Wall Street Week between 1970 and 2005. He's also been featured on CNBC, Fox Business, The Wall Street Journal, and other top financial publications hundreds of times throughout his career. And he's held several positions for financial firms throughout his career. And he is known as the godfather of technical analysis. Before we get started, I'd like to note that while Ralph does have some speaking points for us to go over tonight, this is designed as a discussion. So in Zoom, you have the capability to raise your hand. So if you click on participants in the Zoom call, you'll see that functionality there. So raise your hand or leave a comment in the chat, and we will pause Ralph and then ask him, and you'll be able to ask him the question. And then the last half of the call will be designed as a Q&A session as well. So if you want to wait until that time to ask your questions, you're able to do that as well, and it'll be an open discussion. Without further ado, Ralph Acampora, everybody.
Thank you very much for that kind introduction. Before I start, I want to congratulate Scholars of Finance for putting this very timely meeting together. We're going to be talking about investor sentiment. And I think it's needless for me to say that there's an enormous amount of concern and fear out there about our own welfare and the welfare of our loved ones and family and friends and citizens in the United States, if not around the world. So there is concern. And what I'd like to do tonight is to share with you some of the ways that we in the financial world monitor investor psychology and what levels of anxiety or complacency, depending if you're making a market bottom or making a market top. I'd like to discuss that with you and share it with you. And as I mentioned a moment ago, this is a very, very timely time to have this, this discussion. Before I get into the details, let me just say that there was a gentleman by the name of Charles Henry Dow in the late 1890s in his editorials in the Wall Street Journal wrote about fear and greed in the stock market. So this is something that goes back a long, long time ago, and it's something that's innate in all of us when it comes to finance, our own money, and life in general. Today, you all are very fortunate to have at your universities a subject called behavioral finance, which in a way is another expression of investor psychology. Again, I like to quote a very famous investor by the name of Warren Buffett, who says, whenever he gets the opportunity, buy when the crowd is crying and sell when the crowd is cheering in glory. And I think you'll agree with me that the crowd has been crying, and rightly so, because of what we've just gone through in the last few weeks. But let me give you a little history, if I may. You know, at market bottoms, if I use the word panic, I'm not overemphasizing that word, but there's a selling, there's a tendency as market prices go down for people to literally panic, despite the fact that the company's earnings and dividends might be excellent. They're just in another mindset, and they're literally selling at the next opportunity. That's emotional, that's irrational. You can hear the voices on the floor of the stock exchange yelling, hit the next bid, hit the next bid. That's an environment that I think we have just witnessed, all of us. And I'd like to compare that with previous cycles in the market where we've had panics. And the one that comes quickly to mind is the classic one in 1929, the crash of 1929 that extended to the bottom of 1932. The Dow, that was the worst Dow decline in history. The Dow lost 84% in value. The president of the United States at the time was a man by the name of Herbert Hoover. I feel sorry for the guy because he came in not into the decline. He actually came in the rising part of the market towards the end of 1928. He took office in January, February, March of 1929, just before the market was to collapse. I bring up his name because he had a tendency to say, oh, the market problem is temporary. It's temporary. He was trying to soothe the people. And obviously he was dead wrong. In fact, when he came up for re-election at the bottom of the public really disliked him. It was through no fault of his own. He was trying to calm the public down. And to complement the problem of the crash of 1929 to 32 was the fact that the Federal Reserve, which by the way was formed and established in 1913, 16 years before, and the Federal Reserve really wasn't up to the task. They didn't have the ability or the knowledge or the experience of handling a major crisis. So the market, with the panic, had really no support from the administration and from the Federal Reserve. Interesting. The first real panic that I personally experienced was in 1973-74. If you go back in time, you'll read about the Yom Kippur War with Israel was a surprise attack from the Arabs. And President Nixon at the time, President of the United States, to help the Israelis, sent airplanes and tanks and et cetera to help furnish the Israelis for their own protection and defense. And the Arab countries were so indignant and so upset about it. What they did is they stopped sending oil, and that created the accelerated decline. And the Dow drops 45%. I was there. Very, very painful. Very, very out of control because the market had never seen anything like that. Today, by the way, but the United States was totally dependent on foreigners for oil. Thank God we don't have that situation today, but that was the problem. Yes, there was a panic. Another one that I experienced not too many years ago was the 1987 crash. That was kind of interesting because on Black Monday, I was there and I have scars to prove it, that the Dow dropped 20% in one day. That was the worst day decline in history. And we had a thing at the time that Wall Street felt comfortable with, was called portfolio insurance. Oh, don't worry, if the market's going down, your portfolio will be insured. Well, guess what? It didn't work. And that caused the accelerated decline. Lots of fear. And the one that maybe you don't remember, but you were around, you might have been a little younger, but ask your parents of what they felt like going through the decline in 2007 and 2008 and 2009. Ladies and gentlemen, that was the second worst decline in the Dow's history. The Dow drops 54%. But this time around, the Federal Reserve knew exactly what to do. And the fellow that was running the Federal Reserve at the time was a man by the name of Ben Bernanke. Ben Bernanke got his PhD. His PhD study was on the crash of 1929. So he was really up to date on all that, and he knew exactly what to do to stem the panic. You know, the world came this close to a global depression in 2008 and 9. That was really scary, 54%. I only bring this to your attention because the current market that we're going through right now, as of Monday, the Dow was down 37.9% from its February 12th high. And I need not tell anyone about how fearful people are feeling. I mean, just listen to CNBC or just read the newspapers. There's a lot of concern out there, and rightly so. I mean, I'm not making this any simpler and just to justify it, but when you lose that kind of money that quickly, it becomes a problem unto itself. Well, I think what we've had now is it's something a little different than we had then. We have the Federal Reserve today. In fact, speaking of Ben Bernanke, he was on TV this morning, at least I saw a quote from him. It says, go big. He was very, very enthusiastic with what the plans that the Federal Reserve has been coming out with the last couple of days.
Hey, Ralph.
And
Hey.
Yes.
I just want to let
Yes?
you know that we did get your slides. So those are ready to go whenever you are ready to transition into those.
Oh, that's wonderful. Good. Thanks, Jacob, because I'm just about ready to go with the slides. So I just set for you in motion the feeling. Hopefully I identified who was in place at the time or wasn't in place at the time of these crises. Now what we'd like to do is show you how we in the financial world and the technical world in particular look at trying to capture the emotion, okay? So if we can turn to our slides, are we able to do that?
Yep, Steve's going to present them for you.
Okay. Steve, there we go. Thank you. I think you're at the end. Let me go right to the beginning. And I know I have a lot of graphs here, and I'm going to skip through them because there's too much to go on. Yeah, you're on the back end of that, Steve. There we go. Good. The one that's most popular, if you can get down a couple of pages, Steve, I'd appreciate it, is the VIX index, VIX. VIX index is the put-call ratio. Next slide, please. Is the put-call ratio of the CBOE, Chicago Board of Options, has the put-call ratio on options. And next slide, I think it's the next slide. Next slide. Yeah, put-call ratio. Here we are. No, you just had it.
Okay, it's
it's
lagging a bit between slides, so bear with me here.
Put-call ratio.
Okay, we're going back to slide 6 here. It's going to take a minute.
See on the right-hand side, the complete right-hand side. In fact, it's highlighted in that little bubble of color, that orange color. You'll notice that when the VIX index gets to the level that it is right now, 1.8. This now, you know, puts and calls. Forgive me for doing this, but a call means you want to buy. The put is you're shorting. So what you've got here is an abnormal amount of puts, shorts over the calls. And whenever you get them at this level, look at where the Dow is. You're usually nearer at a bottom. So from this perspective, from the speculator or trader's perspective, there's too much bearishness, and that's interpreted as being bullish. Next slide, please. We'll take another version of market psychology, but from a different audience. See, it says on the top of the slide, AAII. AAII stands for the American Association of Individual Investors. I've been giving presentations to that organization over the years, and they're all over the country. They're upscale, sophisticated public investors. These are mom and pops. Lots of people that I met at these conferences were doctors and lawyers, and so they're fairly sophisticated investors. And what AAII does as an organization, they take a toll. They pick it. They ask their audience, their members, who's bullish or who's bearish every week. So when you get and you can see you have it's 51%. I think it says there 51.15% of the professional, no, not professional, of the public are negative on the market. And if you go back in time, that's except look at that look at 2008, that was well over, was 70%. So you're at a level where you're starting to see the public, not just the speculators or the traders in this put call ratio, but here you have the public. This is mom and pop, and this is their money, and they're more negative than they are positive. I think we have one more slide that we want to show. Let's try the next one, Steve. No, this is too much information. Next one, maybe. Next one, please. Yeah, we'll do this one. I don't know. We don't have time to go into details, but you've seen a chart with the little dots in it, with the moving average. That's a mathematical trend line. I don't get too technical, but what you want is the price to be above that line. And here we have the 40-week moving average. That's taking the closing price of all your stocks every Friday and going back 40 weeks and getting the average price. And that's the dot for the week. And as you can see there, in this particular, where the circles are on the bottom, the percent of stocks in the S&P 500, the percent of stocks that are above the moving average has dropped to under 10%. So 90% or more of the stocks in the S&P 500 are below that mathematical trend line. That shows you that they're wiped out. They're washed out. And you can see, and you compare them to the previous market cycles, that this also is an indication. So let me summarize by saying, when you're talking about the traders, the put-call ratio, they're very, very bearish. You talk about the public, the mom and pops, they're negative. And you're talking about the number of stocks within the S&P 500 that are in strong trends, and it's non-existing. 90% of them are in negative trends. So you're nearer at, I'd say, a climatic low. So I'm going to finish my comments, and hopefully you'll have some questions, by saying, yes, I understand, and I more than sympathize with all of the concerns out there. Okay. And I don't think, again, I'm not a doctor, but the virus in different parts of the country are probably going to get a little worse in New York and places like that. So the tension and the news and the headlines is still going to be negative about the virus. It's just a matter of fact. So I accept that. But what's happened in the last couple of days, and the reason why the markets had such a nice bounce back in the last 2 days, was because the Federal Reserve came in and said, we're going to put so much more money, we're going to put trillions of dollars, we're going to support companies, we're going to support the people. This is never, at this magnitude, it's never ever been done before. And as I mentioned a moment ago, Ben Bernanke comes out, the former head chairman, is saying, go for it. So I think the government is making the right stand. It's doing the right thing. It's a matter of, well, will people take a deep breath and relax? I think that'll take time. So put it in place. I think we're very close to a bottom in the market. I think it's going to be a matter of rallies and pullbacks. And I'll end up by saying the super optimists are saying that we're going to have a V bottom, we're going to turn right around and go straight back up. I'm not so sure about that. I would think that maybe at best you have what I call a W bottom. You had your first low, get a rally here, follow the rally, and then get a reaction, maybe test that low, and then stabilize. So in the reaction is where I would think I'd start to nibble and add to positions or start new positions. And first I'd start with quality, go for the names that the Apples and the Microsofts and the Facebooks of the world that you feel comfortable with. Look for high yield. The utility average just got crushed. I mean, we can't live without turning the lights on and off every day. So we need these things. So I'm bullish on America. I think we're making the bottom, and it's now time to start to nibble. With that, I'll turn it over to you, Steve, and maybe you have some questions.
Okay. Well, I'll take it from here, Ralph. Thank you for that great presentation there.
Thank you.
There were a lot of questions that came in before the call that students were curious about. And when you and I were talking today, one of the big questions that I had was about this huge cash infusion that's going to come from the Federal Reserve. I know they're talking anywhere between $2 and $4 trillion is going to be put into the economy. Talking about fear and greed, I think one of my biggest fears is if they do that, what happens if it doesn't work?
Well, they're going to make it work. Now, I think the question that you posed to me when we were walking around on the farm was, the debt level in this country is really high. I'm not an economist. It keeps me up at night thinking about it. But this is a very full, coordinated, fully supported effort that we have. It's virtual to a war. We're going to war. So the government's not going to allow it to implode on us. So I wouldn't worry about it now. I'd say a year or so from now, then maybe we'll have that discussion and maybe get an economist to join us and talk about in the debt structure. I mean, we had a problem with the debt structure going into this before it happens. And and let's face it, they're just pumping out the money as they can. And I'm all for it.
Okay.
Thanks for
and then another question that I have, yeah, absolutely, is about what we can do as individuals to combat that fear and greed. So we walk through a couple of indexes that represent fear and greed in the market, which is a collective group of people. But what can we do as individuals to prevent ourselves from being impacted by those and being on stable ground when we're making decisions?
First of all, I'd say take a nice deep breath, inhale, and relax. I mean, I know you're young. I'm a little older than you all, but just remember, as a country, we've been through much worse than this. I mean, wars, deaths, pestilence, and plagues. And this is serious, and I'm not minimizing it all. But if you have faith in God and you have faith in your country, we'll come out of it. I think it's going to be a rocky road, but I think if we have another conference call a year from now, I think the message is going to be a lot better, and you can feel a lot better. So I to answer your question, or answer that question, have faith in the country. We'll get through it. That's my answer.
Okay. I do want to open up the floor to anybody else in the call that has any questions. It looks like there's one person with their hand raised right now, so feel free to unmute your mic and ask your question to Ralph.
Hi, my name's Sam. Thank you so much for speaking with us. I was just curious that you spoke about the government's New Deal, well, the Fed's New Deal to put in, pumping $2 trillion, right? And it's an unprecedented thing. It's very positive. Are you not worried that with the Fed doing that, Germany basically saying we will pump in an unending amount of money into companies, UK now taking roughly the same approach, and many other countries, are you not worried that much like, because quite a few economists have said that this is going to lead to, the way this trajectory is leading, is going to lead to roughly what happened in the Great Depression with hyperinflation, because with people going out of jobs and constant money being pumped in through the Fed, through quantitative easing measures, do you not think this is just going to lead to hyperinflation and then everything will go quite a lot backwards?
Well, I'd like to answer that question, but let me ask you a question. How long do you think that this crisis is going to last, this virus? Is this going to be, are we talking years or months? Because if you're talking months, then I think we get by this. If you're talking something that's pandemic and it's going to last for years, and then I throw my hands up in the air and I say, yeah, this is going to be devastating. So I'm in the camp that yes, it's troubling, and yes, but they're doing it to defend their own people, to help their own people. Man, how bad can that be? I mean, I admire the Germans and the French and everybody. I mean, they're doing what they have to do, and they'll worry about the consequences later. But we have to fight the virus. We have to stop it from being much worse than people are forecasting. That's my answer. Sorry.
Thank you.
Any other questions?
Okay. Yeah, there was one of the pre-questions was from Emily Zhu from the NYU chapter. She was wondering how the market recovers from an unexpected pandemic like this and something that's never really happened before.
Well, I've never gone through something like this myself, but I think I outlined a few of the real bad ones that we all went through. As I mentioned, the crash of '29, and the one that was most recent was the economic crisis that we had in 2007, 8, and 9. This is different. This is different because it's not something that we created. It's something that is outside of us. And as I just mentioned to that fellow that asked the question before. I said, if you're in the camp that I'm in, that we're talking about months and not years of eradicating this problem, then I think we get beyond this. I think we come out the other end in much better shape. So I'm bullish on America.
Okay.
Any other question?
Yeah, there's a handful of other ones that were asked beforehand, so I can continue to go through these. Everybody else on the call, you're welcome to jump in at any point if you'd like to. Feel free to raise your hand, or if you leave a message in the chat, you can do it there as well. One was from Shuba from University of Minnesota. She was wondering, in times like this, what helps you maintain hope?
Well, as I mentioned before, I have a lot of faith in our country, and we've been through terrible times. Anyway, I was a little kid when the Second World War was going on, but I do remember the Korean War, and I definitely remember Vietnam because my friends were in Vietnam, and some of them never came back. That was very sad. I had an apartment 3 blocks from Ground Zero when we had the problems with the in New York City with the Twin Towers, and that was pretty, that hit home for me. I mean, literally home. I mean, my apartment was just covered in all sorts of debris, and we made it through. I mean, we're tough. We'll make it. I promise you, we'll make it. We're gonna have to. I'm gonna ask scholars of finance that we have another meeting like this in a year, and I hope you all join me then, and we'll talk about what had happened in the 12 months since, and I'll bet it'd be a much, much different story. And we'll be talking about, hey, when we're gonna meet and go out and have a beer at Joe's Tavern, or go water skiing somewhere. I think you'll feel a lot better. Trust me.
All right. Well, we'll hold you to that, Ralph. It looks like Dennis Franklin has a question. Dennis, if you could introduce yourself with your name, your chapter, and your year in school, that'd be great.
Sure. My name is Dennis Franklin. I'm a first year at Columbia University, and I'm the chapter president here. And I thank you so much for coming to speak with us. And I was just wondering, there's been a lot of opinions about when, in terms of the coronavirus, when exactly we should stop doing these lockdowns of cities and whatnot. Because a lot, like Trump has said, we should stop it by the time Easter comes around, and a lot of other people have been saying we should just let everybody go, and there were some senators saying that they should sacrifice the older generation, and the older generation should be proud of the fact that the younger generation will succeed on their behalf and whatnot. And I was just wondering what you think the balance needs to be between the economic benefit that we would get by continuing our everyday life versus the obviously the moral responsibility of keeping everybody healthy and alive.
Well, first of all, I'm part of that old generation, and I don't want someone to tell me that me and my wife and my friends are second thoughts on this.
Yeah, of course.
Yeah, of course not. I mean, that's silly. I mean, I can't imagine. Just put yourself in the position that you're the president of, no, excuse me, this is not a political statement on my part, okay? But when I listen to the administration, they get on the TV every day, and the guy I'm listening to is that Dr. Fauci. I mean, that's the man I want to listen to. He's the doctor, and everybody just absolutely adores the guy, and he's got credibility. I mean, I wouldn't listen to Trump. I'd listen to that guy first. And if he says, we're going to keep it closed down past Easter, which Trump wants to do, I think I'm leaning with the doctor, okay? I'd rather go with the medical people instead of the politician. I understand where Trump's coming from. You know, he wants to, open the door for business so they can get back on their feet quicker. And I understand everybody's position, but I'm more inclined to say, hey, no. We got to treat the immediate problem. The immediate problem is the virus, and that's primary. And the Federal Reserve and the government itself, they're going to support everybody. Will it be perfect? No, it won't be perfect, but it'll be very, very good. And as I said, a year from now, I'm buying the drinks, and I promise you, we're going to have a good time. Okay.
Thank you so much.
Okay.
Looks like one other person has their hand raised right now. Oh, Shiva as well. So before you go, Shiva, it looks like there's one other person. So if you could unmute your mic and then introduce yourself.
Hello, my name is David. I'm here, a student at NYU. Thank you for speaking to us today, Ralph. So my question is, so as the years have come by, a lot more of the market activity has been done by computers. And so I was wondering if you could like explain kind of how fear and greed has been exacerbated by like quantitative trading and computer.
Wonderful question. If you'd asked it another way, what keeps me up at night? I'd say algos. I have a nephew, and the guy is, his name is Jay Woods. By the way, if anyone wants to get a tour on the New York Stock Exchange floor, let me know, and I can arrange it for you, okay? That's a gift. And his name is Jay Woods. And whenever we have a bad day on the floor, and by the way, they're off the floor now because the stock exchange, as you hopefully you're aware of, is trading off the floor now. So there's no one actually physically on the floor. That's the first time that's ever happened in the history of the stock exchange. And I call him up yelling and screaming and say, Jay, what the heck are you guys doing on the floor? And he'll yell back and say, hey, Uncle, if we had people on the floor, this wouldn't happen. Not to the degree. And it's the algos, by the way, you know, being in school, a lot of that is all momentum driven, the algorithmic trade. Momentum is technical analysis. Remember a moment ago, I was talking about that moving average. And you know what? The algos start selling automatically when those moving averages are broken, different ones for different periods of time, of course. But yes, I'm concerned about the algos. And I'm told that 80% of the activity on the exchange is computer driven. And that's why I believe you're getting these wild swings up and down. I mean, it's amazing. And people ask me, Ralph, what has changed in all the 53 years you've been doing this? And I said, nothing except one thing. If I was a day trader, I can't imagine how they use technical analysis intraday, because the volatility in the computer is just kicking this stuff up and down. It's just it's beyond. I'm not able to handle it. But yes, I don't know the answer to that. I think one day when this is all over, perhaps they'll sit down and they'll start to evaluate the computers. But something tells me they're not about to change any of this anytime soon. So I agree. It's a concern. If it gets really out of hand, and I don't think we're there yet, but if it gets out of hand, maybe they'll change it. I hope they do.
Thank you. Thank you.
You're welcome.
Okay.
Great
The
question.
next question is coming from Shiva.
Hi, Shiva.
Hey, yeah, I'm Shiva Mehta. I'm a freshman at Northwestern University. And one of the questions that I was personally wondering was, how can insider information, I know we've heard a lot of news of some politicians having some insider information about this and that affecting kind of the course of what's happening in terms of the stock market, but just the crisis in general. So I guess my question is, how can insider information further the negative impacts on the stock market, such as the one we have here?
Yeah, the senators, I think they're all senators, weren't that just got about 4 or 5 of them are up on the docket now, and people are saying, hey, you had inside information. So yes, that's illegal, and I hope they prosecute them. But did that particular event, those 4 or 5 people, did they really cause anything, aberration to the market? And did they accelerate the decline? Absolutely not. They weren't powerful enough to do it. So I don't dismiss insider trading. I mean, there is systems in place to protect us from that. But you know, like anything else, I'm sure people find a way around them. So I'm not naive enough to say that there's not insider trading going on. There is, but no, it's not causing the decline. It's part of the reason for the accelerated nature of the decline. Because when they sold, I correct me if I'm wrong, they just said dump, and they got out. So that's part of the accelerated down move, which is part of the panic. But no, they didn't create the panic, not at all. Not at all. Not this particular situation. Good
Thank
question.
you.
Okay, the next question is coming from Nick.
Hi, Ralph.
Hi, Nick.
So in the midst of these
I
times,
can't hear you. A little louder.
can you hear me now?
Yep, slightly.
So this is the biggest QE we've ever done as a nation. $4 trillion is what it's looking like prospective.
Yeah.
And a lot of people are concerned about the fact that banks and these big corporations are going to get a majority of the share. It's obviously to revitalize the economy, but people are concerned long-term about the control that the Fed has to just snap its fingers and add a bunch of zeros to its electronic balance sheet and just, you know, immediately change the course of the economy. How do you think, what are your takes on long-term, the effect of these huge economic measures that can be put into place, and who has power in this country over our wealth?
Well, to begin, this is unprecedented, the amount of money that we're talking about. And I think the politicians, starting with Bernie Sanders and, you know, screaming out loud for the public, for the people. And I think that's the reason, one of the reasons why they're having a little trouble getting the bill passed right now between the senators and the congressmen. And I'm good. I'm glad to see that they're battling it out, you know, and you don't want to see CEOs of corporations at the end, you know, their salary gets tripled and they're all buying back their own stock. But a lot of that is being talked about. So I'm very happy to hear that. So, and I think a lot of eyes and a lot of concentration is going to be on. So, you know, if we had this conversation, let's say 6 months from now, and then you look back and see what has really happened with corporate America and did the public get serviced correctly? I'm sure it's not going to be a perfect scenario, but I think this time around, the public is going to be served well. They're going to be taken care of as best we can. And again, I think we're going to look back a year or so from now and say, gee, the government did the right thing. It wasn't perfect, but we turned the situation around. The country is back in stable mode. And you know, you got these industries like airlines. We can't live without airplanes, okay? And the hotels, they have to be. What about these cruise ships? I mean, I don't ever want to take a cruise ship. What's been going on with that? But those are industries that, quote, need to be supported, and I'm all for that. But you're right. You gotta make sure that it's evenly taken care of, that where the public, and I hope I'm answering your question, but I think they're doing that. I think they're trying their best, and you got a lot of people, especially with the election coming up at the end of the year. So that'll be on the forefront of everybody's debates. Good question.
Yeah, I think we all hope you're right. So thank you.
Yeah. I'm by nature an optimist. In fact, I don't know if you saw it, but I hand painted the largest chart of the Dow Jones Industrial Average in history. On one wall, it starts out when I started in the business in 1967. Okay, that's when I came in the business. The Dow was at 800. 50 years later, 2017, I had to get on a ladder and paint the last chart, the last bar of the Dow was at 24,000, over 24,000. So I have a sign at the bottom of that chart says, Ralph's opinion, Ralph's suggestion. It pays to be an optimist. I went from 800 to 24,000 in 50 years. I still feel that way. It pays to be an optimist. That's my advice.
Thank you for sharing that, Ralph. We did send everybody the video beforehand, but we'll send that in the follow-up email as well, so everybody can watch it and see the barn. I was actually there today, and it's more beautiful in person. Let me just tell you that. Okay, the next question is coming from Neha.
Hey, Ralph. For everyone who hasn't met me, I'm an alumni from the Twin Cities chapter of SOF. Graduated in May. My question for you is in regard to the stimulus bill approved by the Senate recently. The $1,200 is going to be given to Americans making less than $75,000, and scaled for people making under 100. So obviously that one-time payment has been discussed a lot, as have other options like providing immediate unemployment benefits to those affected by COVID, or instituting a universal basic income until this crisis is over, or even, I don't need to go on and on. How do you think that the one-time payment compares to some of the other opportunities that have been discussed? And do you think it's going to instill confidence in consumers to spend in light of a lot of uncertainty about when this is going to end?
And the one-time payment is how much again?
$1,200.
$1,200
for individuals making under 75 grand. For families, double that.
Well, I hope it's enough. Honestly, I don't know. Again, I guess it gets back to the comments I made a little while ago talking about how long the virus lasts. If we're talking months, that money might just eke out enough. If you're talking years, then we're in trouble. That money could never, ever. I don't know the answer, to be brutally honest with you, but the effort is there. And let's say, God forbid, in 6 months or 4 or 5 months from now, they're seeing that it's not working. I'm sure there'll be a big push for the Fed to kick in a few bucks more. And I'm sure it will do that if it has to. So I'm all for taking care of the people, and they're going to do that. You got to be bullish on America. We're a good country. We're good people.
Appreciate it.
Yeah. Believe. Just have faith. We'll come through this. I promise.
Okay. Thank you, Ralph. Looks like we have about 15 minutes left. Time for a handful more questions. Shuba DM'd me one. This is a big one. So she said, seeing all these companies react to the current situation, which companies and/or governments around the world do you feel are doing right by their stakeholders and adapting to the situation with effective policies? And which policies have surprised you the most, either good or bad?
Well, I don't know if I can answer that question. You're talking about how the governments have handled the virus? Is that the question?
So there's two parts to the question. So the first one is about companies and governments, and which, in your opinion, which ones have acted in the best interest of all of their stakeholders? And then the second question is about the policies that have surprised you the most.
Wow, that's a hard question to answer. I just heard on television where the North Koreans are saying they don't have any viruses and that, everything's fine in their country. Do you honestly believe that? I think, God help the Italians. They really got hit very hard. And it looks like, at least what I'm hearing, they've done a decent job, and it's starting to ease up a little bit. If you believe what the Chinese are saying, they're saying that the pandemic is slowing down and they're putting people back to work and all. So right now, if you take in the order of events, I said the Chinese look like they're ahead of the curve. They were the first to have the problem. And it looks like they're, again, if you believe what they're saying, it looks like they're coming along. To say one country's better than the other, no, I think that'd be hard to say. At home here in the U.S., you can hear a lot of criticism that we don't have enough ventilators and masks and this and that. And yeah, I guess the country wasn't totally prepared. And I don't know if it's any one individual's fault. I mean, how do you predict the pandemic? But just look at the workmanship that's going on right now, and the enthusiasm and the support with the large corporations building these machines and masks. And I think we're going to be overwhelmed, but it takes time. So I don't think I could rate any country. I think at the end, when it's all said and done a year from now, maybe it'd be better to answer that question that way. I'm sorry. I just don't know.
Thank you, Ralph. We have another question from Kevin Wu from UC Berkeley. He asked, do you have any career advice for current students who may be graduating into a possible recession soon?
Into a possible recession, get a job. If you can get that job, because it's going to be a little tough, I would think. I would think corporations right now just worry about survival, and I don't know, because I don't know if I have firsthand. I don't know firsthand, but all I can say to you all, whatever job you get in finance, go to work, and once you're in the job, go around and take people to lunch in different departments. Let's say you're in accounting. Well, take the people out to corporate finance, get to meet someone out there and talk to them and see what it's like in corporate finance. You might like that, and they might like you, and maybe you move into or if like I was a strategist all my life and I was doing the technical, go find if there's an individual who's doing it, or a fundamental analyst that follows, let's say, the auto industry or the technology industry. Go around and don't just go into the company and that's all I'm going to do. I'm just going to be this type of person, because you just got into the industry, and the best advice I can do to you is just expose yourself to as many areas of the industry as possible. Because you know what? It's a wonderful industry. I have met I've got the greatest friends, and they're all in different parts. One's an economist, and one's a strategist, and one's in sales. And it's a wonderful industry, and enjoy it, but expose yourself. And if you're in finance, if you're going to be, let's say, a strategist or an analyst like I was, if I had my education to do over, I would love to have been a more exposure to economics, which I didn't have any. I would love to have a CFA, a Chartered Financial Analyst designation. I helped create the CMT exam. That's the technician's version of the CFA. I would get both of those, because then you've got both worlds. I don't call one subject better than the other. I call that fusion analysis, when you can take all the disciplines and put that together. That's the best advice I can give you.
Okay, thank you, Ralph. Looks like we do have one hand raised right now, so please unmute your mic and introduce yourself.
Hi. I have one more question, but it's
I got you again. Good.
But it's less about sort of the doom and gloom and work stuff that this has been about, but more why, after you decided to take a step back from full-time work, did you decide to go live on a farm? And very big difference, I assume, from your life in the city to this. And I'm not that far ahead as of yet, but I'm just curious, why did you choose that path?
Okay. Well, first of all, I'm 78 years old. Okay. I tried to retire in 2007. It lasted 2 weeks. I'm serious. And I got sucked back in to the school that I used to do, the School of Wall Street. And I've been teaching technical analysis since 1970. The school was owned by Pearson, the publishing company. In 2007, they said, we got you full-time instead of just Monday nights. And they sent me all around the world, to China and India, Pakistan. I went all over the place talking about how to read the market. And then my cousin, Tony Acampora, and he used to be with Russell and Company, and Russell and Company was bought out by Northwestern Mutual Fund, and the top management of Russell and Company retired. And my cousin was part of that, and they said, no, we're going to start our own little company, and they sucked me into that. And so I advise portfolios, I advise family funds. So I never stopped working, and I got to tell you, God bless my wife, she's such a doll. She twisted my arms. Oh, let's go out to Minnesota. And we have a beautiful home here. And my father-in-law, Charles Sherlock, the man is 94 years old. God bless him. He put his arm around me 6 years ago. And I said, well, Ralph, the farm has been in the family since 1858. He wanted me to buy it. I said, Dad, I'm from New York. I know muggers. I don't know anything about horses and cows. I didn't want to buy it. Then my wife, unfortunately, got ill. And then they were raising horses out there, and Rosemary just loved horses, and I had the big smile. I said, I got to buy the farm. I got to tell you, it's the best thing I ever did, because I work in the morning at the computer screen right here. I get up at 6 o'clock, which is 7 o'clock in New York, and I do my thing, and I'm emailing my clients in Saudi Arabia and in London and Scotland and Ireland, wherever they are, and I give them some ideas, and around 11, 12 o'clock, I'm finished. I get my dog, Henry VIII. He's an English master. I put him in the car. I go out to the farm, and I have fun for the next 4 or 5 hours. So I have the best of both worlds. I use my head in the morning and use my back in the afternoon. And I'm still doing it. And God help me, I'm going to continue doing it forever and ever. So thanks for asking. But it's what life is. You know what? You would have asked me 10 years ago, you're going to wind up owning a farm in Minnesota. I'd say you're out of your mind. In fact, my good friends in New York are saying, what are you doing in Minnesota? And I love it. The people here are great. It's just, and people ask me, what's the best of both worlds, New York or Minnesota? I said, you can't ask that question. They're two different worlds. I love New York City with all this excitement and getting on the train and all that sort of, but out here is so peaceful, and I have such respect for farmers, the hardworking people. And remember, they feed us, so we need them. Thanks for the question. Sorry I had a long answer.
Thank you.
Good.
Thanks for sharing, Ralph. It looks like we do have one person with their hand raised right now, so please unmute your mic and introduce yourself.
Hi, I'm Holly. I'm a fourth-year statistics major from Berkeley. And my question was just how do you think that the banks are going to be affected? Because I read recently that Bank of America was going to forgive late mortgage payments. So what are like the long-term effects on these banks, or maybe short-term? And thank you.
You're talking about this whole situation with banks in particular?
Yeah.
Well, that's a great question. Remember, I was referring to the big decline in 2007, 8, and 9. Well, at that time, the banks were too big to fail. You remember that? In fact, there's a good book. I have it behind me. It says Too Big to Fail. And the banks had a lot of problems then. And the government, Federal Reserve came in and had to support them and rebuild them. The one major difference and the one major positive about this horrible situation we're in right now is that the banks don't have a problem. They're very strong, and in fact, they were just saying the other day, the bankers were getting on television and saying, we're ready, we can handle this. And so I'm not worried about that part of it, not at all. In fact, that's a great question, but there is a difference. We're different now. We learned our lesson in 2008 and 9, thank God. So we're in better shape that way. Good question.
Okay, thanks, Ralph. Looks like we have time for one or two more questions. Chad has his hand raised. Go ahead, Chad.
Hi, Chad.
Hi, Ralph. Thank you so much for speaking with us today. I was wondering, with you talking earlier about getting to know people in different divisions within the bank, something relating to that, how were you able to manage like different personality types within Wall Street to lead to your ultimate success? Because I know that could be big, navigating different type of personalities or egos, if you could say that.
Well, it's how you handle them too. Well, let me back up. Being a technical analyst in the late 1960s, early 1970s, We weren't treated very well by the fundamental community. If you recall, you probably don't, but go in your book, you'll find this thing called random walk, the efficient market hypothesis. But they were very negative on people like myself. And I met a young analyst by the name of Johnny Brooks in 1969, 1970. And we were kind of upset that, we weren't getting, not that, if I use the word respect, I'm not talking about me getting respect, but the subject was not getting respect. And so we went out and started this organization, the CMT Association. And Johnny and I never thought it would ever last 50 years, but it is. And it's got the own exam and everything else like that. So yeah, I had to deal with people who looked at what I did differently and initially didn't put much respect on it. But I got to tell you, over the years, and I made my mistakes in the market, but I had a couple of great calls, not to brag or anything, but in 1995, my career took off because the Dow was at around 3,800 and I write a 58-page report called Dow 7000. And everybody thought I was out of my mind. And Dow not only went to 7,000, I raised it to 10,000. I caught the whole move. And the rest is history. So bottom line, be good at what you're doing, and your success is measured not by who you are, what you look like, it's by how well you analyze and how well you perform your job. So had I not been able to capitalize and, make some real good market calls, I don't know if I would have ever gotten any kind of respect. So be good at what you're doing. Let me just say one thing to you all. This is a wonderful industry. And if you really get into it, you're going to love it. Just remember I was saying, pick around, go around and talk to different people in different parts and find out the area that you really like. I tell you, I tell this to everybody. If you find out something that you really like, you'll never work another day in your life. I haven't worked in 53 years. I love it. All the ups and downs and I had my share of market calls that didn't quite work out. But another thing I'll pass on to you, don't be obstinate. If you're wrong, change. That's a very optimistic, and be humble about it. And say, well, I made a mistake. And people respect that. You're not going to be right all the time, but at least give yourself an opportunity to wiggle out of the move and say, hey, for these reasons, I made this call, and those reasons have changed, so I have to change my call. Be open, be honest. People will respect you.
Thank you.
You're welcome.
Thank you, Ralph. And thank you to all the Scholars of Finance for joining us for this evening. This has been incredibly informative, and we're really grateful that you're here to talk with us, Ralph. Next week for our speaker series event, we will be hosting John Taft, the Vice Chairman of Baird, and one of our advisors for our second speaker series. In addition to that, we'll be sending out a feedback form and would appreciate your thoughts. This, as you know, is our first event at the national level. We would value any feedback that you have to offer. There's no need to tell me about everybody being named Jake Crayons. We're already aware of that, and we'll figure that out for next time. In the meantime, we hope you all have a great rest of your week. Stay safe and stay inside.
Thank you very much. I enjoyed it.
Thanks, Ralph.
Thank you.
Thanks, Jake.
Thanks, Ralph.
Thank you.
Thank you.
Thank you.